David Tepper, I think, is a fantastic investor. He just recently had been buying the company. Maybe this is a bit of a value play. There's a few guys here who have been adding quite aggressively to their ViacomCBS position. I think these guys think it's a value play, so I'm very interested to go see the price. Hey everyone, welcome back to the channel. We're going to do another high-level valuation today of a company called ViacomCBS. And what I'm trying to do here on my channel is explain that investing in the stock market is more than just buying a company you love and just watching it go up. There's a lot of people who are going to get crushed by this sometime in the future, and I'm trying to help you avoid it. Maybe you're a little concerned that something doesn't feel right about all the hype around cryptocurrency or Tesla or what have you. Well, you're not alone. My strategy is to look at an investment based on its financials, just like we would want to do if we were to buy the entire company and run it ourselves. Now, I'm not going to do a full analysis here. I don't have the time to seriously analyze the thousands of companies out there, so I'm trying to filter them out as best I can using this method. Look, even if the company passes or fails this quick valuation, it doesn't make it a good or a bad investment. It's just a way to motivate me whether I want to go onwards and do further research and study the company in serious detail. Look, just sit back and follow along to learn how to do this yourself. Plus, by the end of the video, I will have a target buy price for you. Look, it's part art and part science anyway, and the more practice we do, the better we're going to get. So let's jump into this one. Okay, now to do my quick valuation of ViacomCBS, I'm going to go through my 9-point checklist and then give my opinion at the end. So, ViacomCBS, a very quick outline of what it is. It's an entertainment producer. They're about a $26 billion market cap company at the moment. There's some pretty interesting assets here. I think they're pretty strong. Like, you've got the Nickelodeon brand and all the stuff that's on Showtime and MTV and Comedy Central and Paramount Pictures. There's some pretty cool stuff here. There's a lot of competition in this space though, like Netflix, of course, but all the other content producers out there. It's a very highly competitive field. So that's going to be my issue we're seeing in the financials about growth and things like that. So let's go into the details. All right, revenue growth is the first thing I want to see. And okay, so for the past, so we've had a jump up in 2018 to 2019. It's gone from 14 billion to 27 billion. There's obviously been a acquisition here. It's probably the ViacomCBS merger it looks like it's been hit the books about here. So it was from 2011 to 2018, it was gone from 14 billion to 14 billion. There's been no growth. And then 2019 to the trailing 12 months is actually gone down a little bit. So there's no growth here. I'm gonna have to give that a cross. All right. Now, gross margins, I like to see relatively high gross margins, around 40% is what I'm looking for. And yeah, we actually have very stable gross margins here, ranging between 37 and 42%, but that's actually pretty consistent. I'm happy with the gross margins there. The margins of this business are pretty good, so it's not a bad business to be in. Return on invested capital is next. And when I look at return on invested capital, this is how good the management team are using the free cash flow that they generate to reinvest back into the business and grow the business. This is just like a metric to show how good they are at doing that. So return on invested capital has been a little bit all over the place. There's a low 4%, a 5% number here. It's actually not too bad. It's a little bit lumpy. When the merger happened, it's about 10% return on invested capital. It's actually okay. I'd probably need to do a little bit more digging in here. But that inconsistency is probably bothering me a little bit. I'm going to give them a cross just because that inconsistency, but it could be very easily a tick. I'm on the fence here. I'm giving them a cross for now. Not a big deal. All right, let's look at the debt. Now, the debt is obviously how businesses get into trouble. If a company doesn't have any debt, it's pretty much impossible for them to go bankrupt. So what I'm looking for here is a current ratio above a 1.5, and our last quarter, yes, we have a 1.78. Happy with that. So we can give them a tick for debt. They can handle their debt at the moment. Free cash flow. Okay, free cash flow has it been growing or not? Okay, so from 2011, it was 1.5 billion, and then 2018 was about 1.2. So there was actually a slight decline over before the merger. And then since the merger, it's been growing very quickly. Probably need to do a little bit more digging here. What am I going to do here about that? I might give them a tick because it has been growing of late, but I want to keep an eye on that free cash flow number. I'm not sure whether that can grow like it has been growing, especially with the revenue being very flat. Free cash flow is going to struggle to grow from here on in, but it has grown a little bit of late. Okay, we'll probably give it a tick. Brokerage accounts. Now, this is really important. You don't want to get stuck with a bad brokerage account. I think we're already taking enough risk when we invest in these companies that we don't want the brokerage account to go bankrupt or anything like that as well. I'm very concerned about things like Robinhood and Webull and all their startup companies. They just don't have any long history or stability in their previous earnings or their management team or anything like that. So I want to go with a safer brokerage account. I don't care if I have to pay very, very small fees, maybe $2 or $3 per transaction. It's not a big deal for me. I highly recommend going with a reputable brokerage account. It makes me sleep at night. And you also get, with Interactive Brokers and Saxo Bank, the brokerage accounts that I use, you get access to the international markets. And that's really important with investing. Not all the best companies in the world are in America or Australia or location dependent. I like to invest in Japan and England and Australia and Canada, and I need access to the international markets. So Interactive Brokers have the lowest fees. It's the one that I use. I actually use both of these, but if you want, there's links in the description. They are affiliate links, and it's just because I use these brokerage accounts myself. Okay, shares outstanding. Now, if this number is getting bigger, it means we're getting diluted, and that's a bad thing. If this number is getting smaller, the company's probably buying back shares, and that's a good thing. So I want to see the last few years has actually been growing. So that's not a good sign. They've been issuing more stock. I'm gonna have to give them a cross here. It means our ownership percentage in the company is getting worse. Okay. Insider ownership. So I want to see the management team aligned with us as shareholders. So if I turn over to Simply Wall Street and I look at the leadership team, now I have a look at the president, the VPs, they're all getting paid. Well, the president's getting paid $38 million a year, but he only has $12 million in stock. The VP's getting paid $11 million, it looks like that doesn't have any insider ownership. The VPs are getting $3 to $5 to $6 million, but they only have about $1 million in stock. The incentives aren't aligned here. Their salary is more important than the stock price, and that's not what we want to see. So I'm going to have to give them a cross here. We definitely want, what I'm looking for is their salary, the stock ownership to be about 10 times as big as their salary. It means that it's far more important what happens to the stock price in the company in the long term than it does their salary. I don't like seeing their salaries being more important. Okay, then we go look for super investors, if any of them have invested. And the reason I'm doing this is because I'm not that smart. And I would build a lot more conviction in an idea if someone who has like decades of experience, a fantastic investor, someone who I respect, if they've invested in this company, well, that means a lot more than what I think of the company, in my opinion. It's gone through their filters. So there are a fair few, here in Data Roman, there's actually quite a few portfolio managers. David Tepper, I think, is a fantastic investor, and he just recently had been buying the company. Maybe this is a bit of a value play. There's a few guys here who have been adding quite aggressively to their ViacomCBS position. I think these guys think it's a value play, so I'm very interested to go see the price and what I think it's worth. So yeah, happy with the gurus at the moment. Okay. So turning to price, price is the most important thing. Anything can be a good or a bad investment depending on the price that we're going to pay. So what I want to see here is I'm going to use my intrinsic value calculator. Now I've gone ahead and put in some of the data already. Now the growth rates like we saw with that revenue, I know the free cash flow was growing just of late, but the revenue's not growing. So I can't see the free cash flow growing at 10% when the revenue is flatlining. That doesn't make any sense to me. They kind of have to be going up together. So I'm putting the growth rates down to pretty much for 0, 2% for the next 5 years to be hopefully a bit more positive. And then flat after that. They're just a cash producing machine, and that's all it is. Now I'm using a discount rate of 30%. Now you might think that is insane. And if I wanted to put this down at 10%, this would give me the fair value of the company of about $30. But I need a margin of safety, and I want returns on my investments to be in the 20% range. So if I aim for 30, it's sort of like I aim for the stars and I might land on the moon kind of thing. So I aim for 30% and hopefully I'm going to get somewhere in the 20% range. So fair value, like I said, was, what did I say fair value was? $30. But if I use my big aggressive 30%, well, I'll show you in a moment, but it gets down to the negatives. Now, the multiple I could sell it for, a cash flow producing company, if it's stable, probably going to get 15. I would say that's on the high side. This is the free cash flow number. This is the shares outstanding. Remember that shares outstanding is growing, so that's a problem as well. And then they've just got the total cash and the total debt. They have more debt than cash at the moment. And it's saying that I want to buy it at negative $3. Now, that's just because I want such an aggressive discount rate. It means this is a hard pass for me because obviously you can't buy things at negative $3. Maybe if you wanted to get 20% with a margin of safety, maybe you're only getting 15% return on your money. You buy it at $7. Or maybe you want like single digit returns for whatever reason. You'd be buying this at $30. If I go and have a look at the stock price right now, it's actually $40 at the moment. So this is not even way outside my my comfortable levels here for an investment based on that price. Way overpaying. Look, maybe I don't know. Look, if you have a look at what's happened in the stock price for the last, well, here's the last year. I know this is a little bit small to see, but it had a massive run up here, all the way up to nearly $100, and then it's fallen dramatically. It's only cut in half. It's actually more than cut in half, back down to about $40. So maybe I'm missing something here. Maybe this is a bit of a value play, and that's why the gurus are getting on board. But they must know more about this company than me. What do I think? So let me give you my opinion. So some of that IP that they have is probably pretty interesting and probably going to generate a lot of cash for the future. But all these other metrics are pretty questionable. Like the free cash flow, I don't think it's going to grow. Those debt levels weren't fantastic. That return on invested capital was on the fence already. I don't know. Competition in this space is also incredibly high. Everyone's competing for viewership. Netflix is a big player as well. You got Amazon, you've got Disney, there's a lot of people vying for attention here. I don't know, maybe this is a turnaround play and that's what the deep value investors think. Maybe they're going to move into streaming services and be really successful and have better gross margins and better free cash flow and things like that. But for me, that price, I'm far away. I'm actually staying completely away from this one. I'm just going to rule this one out completely. I don't think it would ever get to a price based on my intrinsic value calculator. Again, it's free. It's in the description if you want this calculator. But me trying to get my my goal of in the 20% range with a margin of safety is I pretty much can't buy this stock. So look, I hope you've enjoyed this analysis. I'm probably going to get a bit of a fair few conflicting comments here, but that's totally okay. This is just the way I do things, and I hope you've learned something from it. And if you have enjoyed the way I do things here, please subscribe to my channel so you don't miss future videos, and I will see you next time.